back several years ago, before the pandemic and before some of the craziness that happened, I was analyzing markets, and there was a lot of concerns about, say, stock valuations, how expensive they were. And I was saying, okay, this is, that's a legitimate concern. There are a number of highly valued equities out there. There's also some cheap ones. But I said the more remarkable thing is what's going on in the bond market, where, you had, mostly in Europe, you had a lot of negative yielding debt. And then you had basically zero yields in Japan. In the United States, we had, near zero in the short end of the curve, a little higher, when you go out. And so basically, it's super low yielding debt. Most of it was below the inflation rate. And the idea was that inflation's dead, it's never coming back. Was one thing I looked at from researching history is that normally when countries get very indebted at the sovereign level, so very large levels of debt relative to GDP, they kind of go past the event horizon where that debt is ever going to be paid back in purchasing power terms, right? And so obviously different countries, depending on their debt profile, will handle that differently. If you're an emerging market and your debt is denominated in a currency you can't print, like dollars, or if you go back long enough and some, countries would have like gold reparations and things like that, they can't print those things, and so they could outright default on some of their obligations or restructure them, which is another way of saying default. Whereas if the debts are denominated in their own currency, normally it's through inflation, right? So it's financial oppression holding yields below the inflation rate. And the kind of the post-war era, in Europe it was the 20s, and in the United States and much world again it was the 40s, where a lot of that sovereign debt was eviscerated in real terms. And I started to see kind of a similar dynamic building here. And none of the risk was priced in my view. I think it's, some of that's been priced better now, but I still think that, I mean, this has been a historic bond crash globally. Tens of trillions of dollars have been in paper wealth been wiped out of the sovereign bond market, let alone, the corporate bonds that are, all the other types of bonds that are kind of, associated with those yields at a higher level. And, going forward, say treasuries are less terrible looking than they were, but generally speaking, I think most sovereign paper wealth is not going to do very well in purchasing power terms, say, over the next decade. There's a growing issue where, ironically, the United States like dollar market, as big as it is, it's not really big enough to serve the whole world anymore. When this system was constructed with the dollar and the treasury at the core of the system after the post-war era, the United States was over like 40% of global GDP. It was kind of like the last country standing. And it had all the gold, it had all the military, and it had all the economy, the industrial capacity. And as things have been rebuilt, and then as multiple countries have risen in power, we live in a more multipolar world now, right? So the United States is closer to 20% of GDP, depending on how you look at purchasing power parity, will be less than that. If you look at nominal dollar terms, it's a little bit above 20%, but it certainly, reduced its share of global economy, but it still has a very large share of that global payment and reserve volume. And I think it's kind of squeezing parts of the world out. And now, obviously, for geopolitical reasons too, but I think even before some of the events of this year, there is a recognition among multiple countries that they want to, diversify their payment and reserve, uh, situation. That's different than saying, we don't want to hold any treasuries, but it's saying we want to diversify the types of assets that we hold. And then for some of the largest countries and some of the largest currency blocks, they had an interest in being able to, say, purchase oil in their own currency, and then have those oil producers maybe hold, those sovereign bonds. And so it's you're actually kind of it's a circular economy there where, say, China can buy oil from, Russia, and then Russia can take that currency, they can hold it, they can also go back to the Chinese market and buy, electronics and things that China produces because they're a large manufacturer. And I think that's the world we're still kind of headed towards. It's a more multipolar world. And then I think, this year certainly added some fuel to the fire because now every country realizes that there's counterparty risk with where they hold their reserve assets. And so I think that, there's multiple things that have been not good for the bond market. And if you're say an oil producer, or even if you're an oil consuming country and you're holding reserves, and those reserves are losing value relative to oil, for example, kind of hard assets, it's a melting ice cube. And so no oil producer wants to sell all of its, like, kind of finite resources and then put them into melting ice cube assets. At the same time, if you're a country that is holding those reserves because of the idea that, in the future, they can hold their value and you can buy, say, oil or other imports with them. If that is a diminishing value, it cheapens like the purpose of reserves. And so I think we're kind of undergoing a transition here. Well, so there are people that study those nuances of the gold market at a much deeper level than I do. But a general trend that we're seeing, obviously, is that gold's moving from west to east, essentially, right? So a lot of the physical gold is going to China, going to India, going to Turkey, going to Russia, as you pointed out, multiple countries throughout kind of Eurasia, the BRICS nations, and so there's that general migration of the physical metal, where some cultures they either have the trade surpluses to absorb it, or their society values it more, views it as more of a store of value, whereas a lot of Western investors have somewhat lost interest in it, and a lot of the Western countries are running these deficits anyway. So there's this general flow, which kind of corresponds to the rise of power of Asia as an economic force in general, and so we are seeing kind of that those interesting dynamics in the gold market, and it's obviously been a long story where multiple people can think they have exposure to gold and not really have exposure to gold. Like if things really hit the fan, if you kind of put the cards on the table, who has the gold? A lot of people think they have gold, but if they actually were to all kind of call on those claims at once, some of them would be obviously left without it. And I think that the market is kind of going through that process to sort some of that out. And obviously that can have long-term implications about price, right? Because if you can increase the supply of claims without increasing the supply of the underlying, that can obviously be negative for pricing. Whereas if you have a kind of a truer perception of where the gold is and who owns it, that can be constructive for price as long as the demand is there. And so I think that's a trend we're seeing. And it's interesting because gold, obviously gold's had a rough year this year, but if you compare it to like long duration bonds, which is one of the closest things you'd compare it to, gold held up better than most long duration bonds did. So it was, it didn't go up like a number of people would have hoped, but it did some damage control in a portfolio or in a net worth. That you have, these specific conditions. That's something I've been tracking in a broader scale, not necessarily focusing on those refiners, but for example, because of the energy shortages in Europe, there's a number of energy intensive industries that have either voluntarily shut down or been basically given like a kind of an order to shut down. And so you've seen that in fertilizer companies, you've seen that in multiple types of metals producers, as well as obviously consumers trying to ration their energy where possible. And so that obviously can have an impact. And it's often during these idiosyncratic type of events that broader things get revealed, right? So I mean, the idea of a market where people trade claims on something and then never take physical delivery is kind of it's kind of a game, right? But then if there's events every once, a few times in history where people actually say, wait a second, we actually want this, it's kind of a test on that system to see, how's that going to go, and it kind of keeps the industry more honest, that when delivery has to happen. And then there's also, I mean, I think that a number of sovereign buyers over time, I think I've realized that custody matters, right? So a number of countries hold their gold outside of their jurisdiction, and a number of them have kind of over time decided to repatriate that gold. And to the extent that they continue buying gold, they generally want to, some of them want to bring it in their borders, as well as private entities in those countries. I think as we move towards a more multipolar world, kind of east and west, maybe trusting each other less, or multiple different parts of the world trusting each other less, that question of custody matters more. And so I think that the goal can become less kind of centralized and more spread out to those jurisdictions. And I think that's a general trend.